Every finance textbook will tell you past performance doesn't predict future results. And yet one of the most replicated findings in all of academic finance is this: stocks that performed best over the past 3 to 12 months continue to outperform over the next month. This anomaly has persisted for over 200 years of data across nearly every asset class. Today, we break down exactly how it works. Welcome to Quantify. Momentum was formally documented by Jegadeesh and Titman in their landmark 1993 paper, Returns to Buying Winners and Selling Losers. Carhart added it as a fourth factor in 1997, showing winners minus losers captures 0.7 to 1.2% per month. Fama and French confirmed momentum survives all controls. Momentum has since been documented in international equities, bonds, commodities, currencies, and, as we will see, DeFi protocols. The standard cross-sectional momentum signal, MOMI, equals the trailing 12-month return for asset I, excluding the most recent month. The momentum score labels the left side. The right side is the 12-month return window, running from month T-12 to T-1. Why skip the last month? Short-term reversal is documented separately and contaminates the momentum signal. Skipping T-1 removes this noise. Implementation: compute the score for every asset, rank them all, go long the top decile, the winners, short the bottom decile, the losers, and rebalance monthly. Here are 10 assets ranked by their trailing 12-month return. Green bars are positive momentum, these are the winners. Red bars are the losers. We go long the top 3 assets A, B, and C, and short the bottom 3, H through J. The Carhart WML factor captures this spread, 0.7 to 1.2% per month in the original US data before transaction costs. First explanation: behavioral underreaction. Investors are slow to update their beliefs when good news arrives for a company. The price response to that news is gradual rather than immediate. Good news gets incorporated over weeks and months, not in a single day. The momentum trade harvests this delayed price response. Evidence: momentum profits are highest in stocks with high analyst forecast dispersion, exactly where information is most contested and slowest to incorporate. Second explanation: the overreaction cascade. Past winners attract attention, media coverage, analyst upgrades, retail interest. Retail performance chasing flows pile in, creating a self-reinforcing trend. The trend continues until it overcorrects and produces eventual reversal. Supporting evidence: momentum profits are lower in highly liquid large caps, where information incorporates faster and performance chasing has less impact. Third explanation: risk-based. Winners during good economic times load heavily on the economic cycle. When the cycle turns, as in 2009, momentum strategies crash spectacularly as prior losers explode upward. The premium supposedly compensates for bearing this crash risk. Overall verdict: the behavioral explanation is strongest. Momentum profits are higher in markets with weaker institutional participation, exactly where behavioral biases dominate. Momentum's Achilles heel. In sharp market reversals, particularly after prolonged crashes followed by sudden recovery, momentum strategies can lose catastrophically. March 2009, the bottom of the financial crisis. Prior 12-month losers, beaten down financials, exploded upward 200 to 300% in weeks. Prior 12-month winners, defensive stocks, lagged badly. Momentum strategies lost 50 to 75% in just 2 months. The mitigation: volatility-scaled momentum. Instead of equal weight long-short, scale each position by its inverse 1-month realized volatility. During turbulent periods, when crash risk is highest, recent volatility is elevated, so the scaled signal automatically reduces position sizes. Empirically, Barroso and Santa Clara show that volatility scaling recovers most of the Sharpe ratio lost to momentum crashes. On-chain momentum works. TVL momentum, protocols gaining total value locked over the past 30 to 90 days continue to attract capital and underreaction to protocol adoption signals. Token price momentum, rank governance tokens cross-protocol by trailing 12 to 1 month return. Top decile tokens outperform in bull markets. Revenue momentum, protocols with growing fee revenue attract more users, reinforcing the growth signal. All three are implementable with on-chain data from DeFiLlama, Dune Analytics, or TheGraph. Momentum is real, persistent, and harvestable. Rule 1. Use 12 to 1 month lookback and always skip the most recent month. Rule 2. Volatility-scale your positions, reduce size when 1 month volatility is elevated. Rule 3. Have a crash risk plan, go flat when trailing market volatility exceeds 25% annualized. Rule 4. Treat momentum as a factor allocation, not a trading strategy, it works in size, not in timing. Rule 5. DeFi momentum is implementable with on-chain data today. Final episode of Series 1 next, Hierarchical Risk Parity, a modern portfolio construction method that replaces the covariance matrix optimizer with a machine learning clustering algorithm. Subscribe. Quantitative.